Hello. Yeah. So, good evening, ladies and gentlemen. Just checking if I am audible to all of you. So, a few responses in the chat window will tell me if I am properly audible to all of you. And if you can see the screen as well. Okay, so I can see your comments which says that I'm little less audible to some of you. Okay, I think the quality of voice should have now improved. You can see the presentation as well. Fine. So some comments from some of you have actually made me comfortable now that you all can see me. It's my pleasure to welcome all of you to the third session. Since I can see the participant list building up, I'll give another 2-3 minutes. I'll just discuss what we have done in the previous 2 sessions and what we plan to do in this session, so that people who join even in the next 5 minutes will not miss up on anything. So I'll first start with some of the questions that I saw in the feedback in the previous 2 seminars. So there was a question from one of you, and I think the question came up twice in the first session as well as in the second session. You wanted to know a little bit more about the revenue drivers from other industries. I probably addressed that question in the previous session where I gave you a slide, and I think this presentation would now have been shared by our administrator to all of you. So in the last 3 slides of the presentation that was sent to you last week, you would have seen that I have listed industry-specific drivers for approximately 17-18 industries I have ever modeled into. So I have listed the drivers over there, the optional drivers as well. Now it will be difficult for me to discuss and explain each one of them, but I think if you read through it and if you apply your own common sense, you will see that most of them will start making sense to you. So I hope that question has got addressed properly. If there is any other specific question related to that, probably you can again write that in a feedback and I may look into that again. But I think I have listed a whole lot of 17-18 companies which typically will end up modeling, so that should be good enough as a starting point. Then there are many situations and companies which even I am not sure of the revenue drivers because probably I have not modeled that company. So with that limitation, I think these 3 slides will serve as a good starting point for all of you. There is another question. A couple of participants wanted to know, I mean, they were not from consulting background and also not familiar with the term, so they just wanted to know what are the simplified versions of different consulting and outsourcing activities. I think I also distributed a couple of slides on that. I'll just show that to you. So in the 3 slides in the information pack that was given to you last week, I have also listed the simplified activities which generally offers itself as a consulting practice. So strategy consulting, financial consulting, operations consulting, HR consulting, what they are made up. If you know these many terms, it's good enough. If you know these many terms that are good enough, then there are some more you can understand about each one of them if you do a Google search. I mean, consulting is a very well covered industry. So I think you will get plenty of them over Google itself, which will tell you that. Then there was a question related to paid up capital and treasury shares. Unfortunately, I couldn't cover that up in the last session, but this session, since we are modeling the entire balance sheet ourselves, I'll anyways take up this issue of paid up capital and treasury shares. And I also try to establish linkage between them. So I think that question I will address today. I have also a couple of slides on treasury shares, share repurchase, why treasury shares exist in the first place. So I think that should collectively address your question. I think in the last 2 sessions, again, the questions got repeated, which is one gentleman wanted to know how to make bull and bear case of projection. Uh, while discussing the revenue drivers, I haven't touched that topic. Let me see if time permits, either in this session or definitely in the next section, I'll try to address that point as well. So that point is pending at my end, which I will resort to, which I resolve quickly. Last time, while barging into the balance sheet, there were some questions raised by participants related to deferred tax, deferred revenue. There are terms like deferred contracts, income tax liability. So since we are modeling the balance sheet today, I think all of these terms will get addressed. I have a couple of slides dedicated to this as well. So I have a couple of slides dedicated to this in today's session, so I think that will also address. Then one participant actually requested for incorporation of valuation techniques like DCF and relative valuation, which of course is a part of our training as well, so webinar as well. So the fourth session is dedicated towards valuation if everything goes in time. So we are definitely going to value the company as per discounted cash flow method, discounted dividend method, relative valuation method, or any other method which we deem fit for a company like this. So these were the major questions. Apart from that, there are some typical questions related to quality of the video, the lag between that. I mean, those are the technical errors which may not happen in a session. But other than that, the collective points and the relevant points, I think I have addressed all of them. I can also see the participants list now stabilizing. So we will now move to the session. So what have we done so far? So far, our main focus had been towards importing the data from a 10K and giving a shape to our model. Once we have given a shape to our model, which was primarily the topic of the first webinar, we shifted towards rigorously projecting the revenue. So when we actually projected our revenue, we realized that we have actually tried to force fit a model given to us from Trefis.com. We have resorted to their technique and we have used their numbers. When we use their numbers, we realized that their revenue was not tying up with the revenues reported by the company historically. So we rectified all those errors. How we rectified that, I have shown that personally in the Excel file. I have also created a backup slide, which I'm sure all of you would have got. So we rectified the errors that were there in the historical revenue drivers. Then we made our own projections on the basis of the trend that we have seen in the past and our own understanding of the industry. Then we cross-checked that against the market size of management consulting and outsourcing. So that was one check that we did. And secondly, we looked into the first quarter reports, first quarter filing of the company. We realized that some of the projections that we have made on the basis of annual trends were defeated or were not so in the quarterly report. So then we corrected that on the basis of the quarterly reports. So that's where we spent major time in the last session. Then we moved towards projecting the cost items. So whatever we did, and then there were some general topics. So now that we understand the broad business model and the operating model of the company, so let's say that at this stage we have not barged into the financials of the company. So we have not seen all the line items of the P&L. We have not seen all the line items of the balance sheet as well. The only thing that we have done so far is studied the revenue rigorously, and we realized that Accenture today is close to $30 billion in terms of revenue. We have not seen all the cost items. We have also not seen any of the balance sheet items. But we have thoroughly understand its business model and operating model. The company is primarily into taking consulting contracts, outsourcing contracts, performing it. How they are arranged is they are arranged in a matrix structure. So they are structured across geography, across industrial segments, and then conducting three prime activities: consulting, technology, and outsourcing. So we broadly understand what the company is doing. Now, is there anything that we can infer in advance? Sitting at this stage, is there any characteristic that we can identify on the P&L and the balance sheet of a company like Accenture, whose prime source of revenue is consulting, technology, and outsourcing contracts? So let's see. So as you understand, or we all realize, consulting is primarily a manpower driven industry. So manpower is the biggest asset, is the capital asset as well as an operating asset. Since manpower is the biggest asset, the primary source of cost for this company should be manpower. The manpower cost is hidden into cost of sales. So that's the reason why you'll see that for a company like Accenture or a consulting company, manpower cost should form the biggest line item on the cost side. Manpower expenses included in the cost of services. So we'll see that cost of services is the single line item which will have the highest percentage to sales. Since you understand what is the biggest driver of cost of services not only include the manpower expenses, which is primarily the biggest asset of a consulting company, it also includes all the subcontracts which Accenture will be placing on smaller vendors. So net, apart from manpower expenses, it should also have subcontracting cost. So cost of services by definition should have the highest, it should be eating away the major chunk of your entire earning. So these are two findings that you can anticipate as of now in the P&L. Let's move to the balance sheet. It's again a pure consulting based company, contract based company. So it should not have any inventory in its balance sheet. So you should not see any inventory on the balance sheet of this company. It's again my anticipation. I have yet not looked into the line items of the balance sheet, nor have you. We will do it simultaneously and together. Since it's again a manpower based company, so manpower being the biggest asset, the only thing that it needs to house its manpower is offices, which can be rented premises as well as bought premises. The second thing that you need to operate is the equipment in terms of laptops, computers, and some more knowledge-based machines, so databases and all. So primarily its capex should be towards owning or financially leasing the offices and equipment. So net it should be very low on capex because there is no other source of capex as well. Since it's low on capex, it will also be low on depreciation. Consulting contracts are primarily very well structured contracts where payments and the milestones are very well defined. The clients also happen to be Fortune 500, Fortune 1000 companies, so payments must also be coming in time. The quality of work that they are doing is also good. So the company should be cash rich. If the company is cash rich and it has low capex, then that makes all the more sense that it should not have borrowed any kind of debt. So there should be absolutely zero or near zero level of debt, unless there is an interest rate arbitrage existing in the market, which means the debt is available cheaper than the rate at which you will earn interest on your surplus cash. So net you should be making good cash since there is low capex. So the entire capex should be funded by internal accruals, and hence there is no need for having any kind of debt. Since again the clients are good, contracts are well structured, so you should be having your receivables flowing in quickly, so it should be rich in cash as well as receivables should be low. So on the asset side, the current asset should be typically higher than non-current asset because there is nothing, I mean the gross block will be far lower than your current assets like cash and receivables. So current asset should be typically higher than the non-current asset because unlike a manufacturing firm where the entire investment goes towards, or year after year you are adding gross block, either enhancing the capacity or undertaking a gross maintenance of the setup to improve your production level, here there is absolutely nothing of this sort required. So net your non-current assets should not be a significant part of your balance sheet. A significant part of your balance sheet should be contributed by current assets. Within current assets also there is no inventory, we have discussed, so net primarily should be made up of cash and receivables. So its balance sheet on the current assets side should be very simple: cash, receivables, and some more line items which will have very small or insignificant values. Richness in cash and low level of debt, that also implies that interest income should dominate the interest expenses in the P&L. So we'll see that whether the interest income is in excess of interest expense. So net this company should be interest earning rather than interest paying. Since you also have surplus cash and no debt to retire, nothing to spend into because capex is also low, what are you going to do with that surplus cash? So ultimately you will pay out as a dividend, or you will be involved into mergers and acquisition. So we will see whether the company is paying out dividend or not. My anticipation is that the company should be paying out dividend regularly, and that also a very good part of your entire earnings should be paid out as a dividend because you have absolutely nothing, no other alternate use of cash. It should also be pursuing M&A. If it's pursuing M&A, then obviously some of the transactions or most of the transactions will happen where you will end up paying more than what the book value of the net asset that you are acquiring. Hence, that should also lead to a goodwill creation. So I'm also expecting a line item called goodwill in the balance sheet. We move towards the other side of the balance sheet, which is liability side, liability and equity. So on the current liability, since the current assets is also neat and clean, the current liability should also be primarily the accounts payable. Since we have seen that cost of sales is going to be a major cost head, so that should automatically translate into good payables, because Accenture is a very big company. Some of the vendors, it must be outsourcing or subcontracting a part of work. Accenture, by the virtue of its size, should be having a very good bargaining power with them. So while their payments are realized in time, they might be paying to these vendors as per their own convenience. So current liability should again be primarily accounts payable. Employees are the biggest assets, so you need to create some provisions for employees, such as obligations or post-retirement benefits. There are some provisions, so you want to reward your employees for all the hard work that they have done. So on the current liability side, you should also see some provisions related to employees. Now what exactly will be those provisions, we'll see, but these provisions should typically be retirement benefits, because it's again a high attrition industry. Unless you retain and reward your manpower, it's very unlikely, you are very unlikely to retain them. Hence there have to be many more benefits and many more provisions and funds to be created for them. It's rich in cash. Other current assets items are no inventory and receivables. So if I exclude cash from my working capital calculation, I mean, many analysts will just include cash as well in working capital. So if I exclude cash, you see that receivables will be lesser in amount, primarily because clients are paying in time. So working capital, which will comprise mainly of receivables minus payables, it should be a negative working capital. So we'll seek that, because most of the time your payments also come in advance. That's the reason why you will see deferred revenue types of line item on the balance sheet as well. So my sense is, since it has got a good clientele base, contracts are well structured, so payments are coming in time, so receivables should be lesser in comparison to payables, where you should have a good, where you typically enjoy a good bargaining power with your suppliers merely by the virtue of your size. Again, since you have seen that current assets and current liabilities should be a significant portion of the balance sheet, so liquidity ratio should also be high. Current ratio and quick ratio should be very close to each other, because quick ratio is nothing but, quick ratio considers only that part of current assets which are quickly converted into cash and cash equivalent. Since there is no inventory, so current ratio and quick ratio should also be very close by. Healthy margins. Consulting contracts are generally structured with 50% margin. So if you speak to any of your colleagues who's working in firms like McKinsey, BCG, or pure strategy consulting, you will see that they are working on 50% of the margin. So whatever cost they derive, they actually quote double the price. Accenture here offers a blend of services. There's a consulting assignment. Within the consulting also, it's not necessarily doing all the strategy consulting work. There are many implementation related work as well. So margins there may not be as great as 50%, but it's definitely going to be in the range of 35–40%. Coupled with that, the fact that 50% of revenue is coming from outsourcing, where the outsourcing market is far more competitive than the consulting markets. The margins over there are definitely not going to be that great. Outsourcing per se itself implies that unless you are able to do an activity cheaper than what a firm will otherwise do it in-house, it's not going to qualify for an outsourcing contract. So outsourcing contract by definition will have lesser margins than a consulting amount. So on a blended basis, when we are talking about a margin at a gross level, it should be a weighted average of 40% and 20%, so close to 30–35% should be the gross margin of this company. That's again my gut feel. That's again on the basis of what I have learned about Accenture so far. I have not yet looked into the financials as of now. The capital base is low, margins are healthy. That means all the return ratios should be on a higher side. The capital base, because you are not doing, there's hardly any capex to do, so there is no capex, so the capital base has to be no debt, no capex, so capital base is low, margins are good, so return ratios, all kind of ROC, ROEs are going to be very high for this company. we looked into the history of the company. Accenture was created about way back in late 90s when Enron fiasco happened. So people from Arthur Andersen, which was then a major audit firm, they actually started Accenture. And since then, it has been operating into the field of consulting and technology outsourcing. So it has a good history of close to 17, 18 years into this field. A company which has been into this space for 17, 18 years would have definitely achieved or at least moved towards maturity. So we'll see that all the margins and everything should start showing sign of stability. So these are some 15, 16 points which I have derived on the basis of my own understanding of the business so far. And probably this is going to be the biggest lesson for today's session. How to anticipate few things into the financial statements of a company merely on a basis of limited understanding of its own business. So this also thrives, or this also thrashes away the point that you need to be a sectoral or an industrial expert to actually value a company. There are many more things which you will actually come to know merely by stretching your common sense and by understanding the business and the operating model. So I hope most of you would have seen through these 15 or 16 points yourself. I like to know if there is any disagreement about any of these points. There may be some other observations which I might have missed, so you can definitely add to the list yourself. But net, I feel that there are some clear-cut 15, 16 takeaways that I can have from these financial statements, and I like to cross-check that as and when I move into the analysis of the financial statements. So when I'm talking about the margin, I'm talking about a gross margin. Gross margin means revenue minus cost of sales. So I'm talking about high margin means gross margin. Then there are many other operating expenses. So depending upon the efficiency of the organization, depending upon the size of the organization, the other operating expenses may or may not follow a trend. So on a gross basis, the company should be very high on margins, and that margin should be a weighted blend of 40% from consulting and 20% from outsourcing. So net, the company should be moving close to 30 to 35% of total revenue as gross margin. So as I have told you, since you guys are fresh, and with the time, as the time progresses, we get involved more and more into the mathematics. So I just kept these slides upfront so that the biggest learning for today's session happens. So on the basis of little or very limited understanding, there will always be some 10, 15 good information that you could anticipate right in the beginning. Then as you move into the Excel, you can check, cross-check, and again, depending upon the outcome of those checkings and cross-checkings, you can further strengthen your views. So let's now get into some work, which is, now that I have little understanding of the P&L and the balance sheet, I get back into my model and see where we left last time. So I have already circulated the V2 version of the Excel file that would have come to you through our administrator. Just open that, we'll start from there. So if you recall, in the P&L side, on the revenue build-up side, we have completed the entire build-up. On the ratio analysis, we have started. The ratio analysis started forcefully because we just wanted to see that the revenue mix is tilted more towards outsourcing with the passage of time, as management has expected, and the growth rates should have declined for consulting and it should be increasing for outsourcing. So this 4 or 5 line items were calculated in the previous session, and they also laid the foundation for the ratio. So I come back to my P&L. We have completed till loss on investments. We are left with interest income, interest expenses. So first we'll model the interest expense. Today's session we'll try to complete the entire P&L and balance sheet. It's primarily mathematics. All the hard work that was required for this session was towards estimating the revenues. Once you have estimated the revenues, the hard work is done. Now it's again a process driven. So while I drive the Excel file, I'll request all of you to continue typing your questions if at all you have in this chat window. I'll pay attention to that once I have completed one subtopic. Right. So I move to my Excel file. Now, in a typical situation, what I would have done is I would have seen the interest expense in relation to the debt. So as a first cut, since I don't know anything about this, let me see at what kind of interest expense this company is having. So the interest expense is listed here. I go back to the balance sheet and figure out what is the level of debt. My anticipation is that the level of debt should be zero, or it should be near zero, and I'll explain that. So let's come down. I have not yet seen the balance sheet, so I'll come down and I'll figure out where debt is. So I can see an item here. It says current portion of long-term debt. It's nearly minuscule. Minuscule here, minuscule here. I move down, see if there is any other debt items. Long-term debt, again very small, near zero, again very small. So this is the situation of debt. So if the situation of debt is this, and if you look at into a P&L and see where your interest income is roughly 10 times or even more than the level of debt that the company has. So what kind of interest expense is that? Why the interest expense of this company is so high when the level of debt is so low? So I was haunted by this question for a very good amount of time. So when I started modeling it, or when I started preparing this case to showcase it to all of you, I was very disturbed by the fact that when the level of debt is so low for the company, why the interest expense is so high. So I went to the company's website and dug the information of the investor section. Ultimately, I actually threw open a mail to their investors, to their investor relations department. I posed a question as why the interest expense is so high when the level of debt is so low. So if you open the case study that was given to you, in the case study, I have actually copied and pasted the entire mail that was exchanged with the investor relation team. So I actually wrote to them. So my question to the investor relations department over there was, I have of course morphed the names, I've removed the names because I didn't want to show the name of the person who has written this mail and the person who has responded back. So I asked a question as in, when the short-term and long-term debt is so small on the balance sheet, why the interest expense is so high? And that interest expense was seen to be consistently high every quarter, high in comparison to the debt, or high in comparison to the interest expense that is typically expected for a company with such a low level of debt. Surprisingly, 2-3 days down the line, the person from the investor relation department responded saying that this was the quantum of interest expense, and the interest expense, what you see on the P&L, is actually a bank fees towards LCs. LCs stand for letter of credits. It's also a part of that, also goes towards commitment fees for the loan facilities that we have. They have also given the page number to see what kind of loan facilities they have, and the interest expense on the debt outstanding. So we realize that the entire interest expense that the company is talking about on its P&L is not necessarily an interest on the debt. It's also a fees towards non-fund based LCs or syndicated loan facilities. So let's now understand what's happening for this company. So I go back to the 10K, and they have also given reference to the page number 43. So I go back to 10K filing to figure out if they're talking anything about these things. So I go down and I realize later down the line, so I'll just stop at the page that we were last time. So last time we have been through all these pages, so we will now continue to read from where we left time. So all things we have already seen. We have seen their discussion about all the cost, and this is exactly the things that we're reading last time. So I continue to move ahead. Sorry for the disturbance. I think lots of the participants are saying that they are not in receipt of the Excel file. So I'm just giving it to my administrator so that he can circulate it once more to all of you. So don't worry, it will come to you. So I'll just pass it on. This is Accenture Fin Model version 2. So I'll copy this and give this to the instructor so that he can circulate it to everyone now. Accenture Fin Model version 2, the entire failure. So while the file comes to you, don't worry about it. I'll at least show you how to proceed. So the Excel files will come to you, don't worry. I mean, those who have not got it, you will see it now. The recording of the session will of course be made available to you after the session, so don't worry, that will also come to you. Meanwhile, let's continue to read our 10K. The files will come to you, don't worry. So we have taken note of that, file will come to you. So I continue to read through my 10K. So this is what we have read. So let me figure out if there is anything they are talking about. And all. So there are many things that I can read on these pages. So I am on this page number 42. Now start reading from the top. So net income attributable. So I am on page number 41. Below that is page number 42. They are talking about net income. Below that they are talking about earning per share. Go down further. Now here they are talking about liquidity and capital resources. So I'll read this. So they're talking that primary source of liquidity are cash flow from operations. This. We are paying dividend. We are acquiring complementary businesses. So very much in line with what we have expected in the beginning. I've moved down further. So then they are saying what kind of cash they are generating from operating activities, from investing activities and financing activities. I move down further. And here comes some of the revelations from the management which we are going to make use. We believe that our available cash balances and cash flows expected to be generated from operations will be sufficient to satisfy our current and planned working capital needs. So this is one very good point for us. So we'll model as if no further debt is required by the company, and this should be further supported by our cash flow preparation. So as of now, since we are trying to model interest expenses, the modeling of interest expense is dependent upon what is the debt balance that we are going to happen. So we have to model the debt balance simultaneously. In order to model the debt balance, we need an opening balance to which some more fresh issue will be added if there is a requirement by the business, minus repayments will give me the closing balance. Then I will take an average of opening and closing balance and apply the interest rate to calculate the interest expense. So now this line relieves me, or gives me a very good relief that as of now I can progress, or I can proceed with nearly zero reissuance of debt in the future years, and cash flow should, once I prepare the cash flow, I'll cross check whether this holds true or not, but as of now management feels that the cash flow generated from operations will be sufficient to meet our needs. Below that they are talking about a borrowing facility. So this is the borrowing facility that they are talking. So they are currently having $1.643 billion of borrowing facility. The commitment fees is towards this borrowing facility. So it's like the bank has committed or allocated certain amount of money or fund towards you. So if bank has already reserved a good quantum of money for you, whether you are going to use it or not, you are going to pay some kind of commitment fees. This commitment fees is a part of that is towards processing fees, which bank have actually incurred while processing your papers and then giving this limit to you. And secondly, bank is also losing on some opportunity cost if you are not fully utilizing this. So net, whether you utilize this or not, in order to keep the limit alive, in order to keep the facility alive, you need to pay some commitment fees to them. So this commitment fees that the form is talking about in their mail. If you recall the mail that I have shown, they have talked about a commitment fees. What is that commitment fees is not known to me. Then they are also talking about under the borrowing facilities described above, we had an aggregate of $164 million or 178 million of letters of credit outstanding. Now, why the letter of credit is required? Letter of credit is required primarily by government or government related institutions when they offer you a contract in order to ensure that you perform or fulfill the contract in time. You actually have to submit some sort of bank guarantee or a performance guarantee, which means that you will complete the work in time. You will not run away in middle. Hence, government or government related institutions, the moment they issue a contract to you, they also ask some sort of standby performance guarantee or a bank guarantee. This standby performance guarantee or the bank guarantee is typically known as standby letter of credit in US. And the part of the world which I belong to, these things are popularly referred to as bank guarantees or performance guarantees, but standby letter of credits or LCs are actually, I mean, by and large practically same as bank guarantee. So once a bank guarantee is issued by a bank, which is also a letter of credit, which is ultimately nothing but a piece of paper, no money is exchanged. It's not a fund-based transaction. Ultimately, at the end of the day, it's just a guarantee written on a piece of paper that if there is a default of any kind by the contractor, we as a banker promises to pay you any kind of damage that you incur. So that is in a standby letter of credit. Then there is a letter of credit which is also like if you're trying to purchase a raw material from someone abroad, then LC is a kind of promise between buyer's bank and a seller's bank, which means that the buyer will be compensated by the bank, by the seller's bank, in case the seller, in case there is a default from either party. So that letter of credit, once a bank issues that letter of credit, bank is assuming some amount of risk on your part, hence bank needs to be compensated. So bank generally charges a fees towards issuance of LCs. So that's another source of expense. So now that I have got this information, I move further down and see if there is something more. So I go down, go down, go down. On the next page, page number 45, so this is the page that I'm talking about. They have also listed all their obligations and commitments. Towards the obligations and commitment, the first line item is long-term debt. They are saying that they are absolutely nothing to pay over the next 5 years, but the amount is so minuscule that net it appears to be zero here. So we have checked in the balance sheet, the existing balance sheet, the existing level of debt on the company itself is very low. So, and there is no payment, repayment required. So this has simplified our life. I'll move to my Excel. Even if you don't have this file with you, don't even worry, just look at it, the file will come to you. So now I'm trying to model the interest income. So I'll insert a sheet called interest. So I'll rename the next sheet as interest expenses. I'll copy and paste the headers and footers from there. So, right, so I think within next couple of minutes you all should be receiving it. So I copy this entire header from here, paste it in my interest expenses sheet. So I simply pasted. Now look at it. So what are the sources of interest expenses? The sources of interest expense, first one is of course the commitment fees. So I need to know what is my syndicated facility. So the fees will be some portion of that. I need to know what is my LCs outstanding. So there will be LC fees on account of that. Then I need to know what is my average debt outstanding. So my entire interest expenses is made up of these three heads. So syndicated facility in FY12, so I go back to my sheet, write 10K filing and I figure out where it is. So here we have realized that company is currently having a syndicated facility of 1.643 billion. So I go back, syndicated facility 1.643 billion. This figure can be picked up for historical years from the respective historical 10K filings. So I have done that. I just don't want to show it again, but you can refer to the previous year's 10K filing and you can pick up the syndicated facility figures from there. I am listing the figures which I have picked up from the previous years. So it's 1.849 in the previous year. In FY10 it was close to 1.716. So I picked up the figures from the historical years. So I'll figure out what was the average facility size, since we are trying to figure out a P&L item on the basis of the balance sheet, a P&L item interacting with the balance sheet, so the balance sheet items should be taken an average. So I'll do an average of this, say enter. Now as we require that cash flow from operations is good enough to take care of all the future needs, so we will maintain going forward the syndicated facility size as this. The company has also said that the syndicated facility is likely to, so syndicated facility is now been replaced by a facility which is going to mature in 2016. So I am assuming the same facility will continue in the historical years as well. So I link it to this level. I'll say enter. So this becomes my syndicated loan facility there. So I will average it out. Then I look at the LCs outstanding. So I again go back to 10K. Here down the line, they are mentioning here that the LC outstanding this year is $178 millions and 164 millions last time. So I'll pick up those figures. So it was 178, 164. So it becomes 0.178, 0.164. FY10 figure can be picked up from the historical balance sheet, which I have picked up. So that is 0.152. This I'm sure you can do yourself. So just average it out. Now LC is given as a commitment of performance for some of your contracts. So this should have some linkage with the total revenue before reimbursement. A part of the total revenue portfolio must be coming to us as projects related to government or the big parties who must be insisting on letter of credit as a standby performance guarantee. So I will go to my assumption sheet and I will figure out how it looks in comparison to. So I have started modeling financing section. So financing assumptions is the heading. LCs as a percentage of revenue. So linkage is percentage of revenue before reimbursement. So I copy and paste it here and I express what percentage of revenue it was in the historical year. So this equal to, I go back to my interest expense, average LC was this, divided by, I come back to my P&L and revenue before reimbursements, this figure, I say enter. So it was 0.7%. I drag it. So look at the kind of stability that these ratios are displaying, 0.7, 0.6, 0.6. So I'll retain the same percentage going forward. So I maintain this. If that is the kind of LC that I'm having, so in the future years I can calculate this. So this should be, I pick up the percentage from assumption sheet, multiply with the numbers that I have already forecasted. So in the P&L side, I have forecasted a revenue before reimbursement at $28.5 billion. So I multiply that, I get a figure for this. I drag it. Ultimately, I end up getting figures for this. Now I move towards average debt outstanding. So what is that portion? So I come back to my balance sheet. I figure out where the debt is, and I'm very happy because there is a current portion of long-term debt and bank. I have realized that ultimately the company is neither repaying anything nor it requires any additional funding, because it feels that all. So if you read this line again, we believe that our available cash balance and the cash flows expected to be generated from operations will be sufficient to satisfy our current and planned working capital and investment needs. So on the basis of that, I'm assuming that no further issuance is required. Down the line, you can see there is a repayment schedule which company has given. So it's here also is almost zero. So I go back to my Excel sheet. Now we have two options. Either we make that the outstanding debt itself is very low. So either we make that as zero or we continue to retain it at the same level. So I will ideally make it debt free because there is no requirement of funding going forward. So the long-term debt is nearly zero. I'll retain some debt as current portion of long-term debt because some debt by and large will still be required by the company. So instead of making this zero, I'll keep this at the same level. So what I'm saying is every year company is borrowing some amount which it's likely to repay next year. Again, it borrows some very small amount and repays. You can make this also as zero. There is absolutely nothing because management is it requires an extremely high level of confidence of the management to make a statement that I have sufficient cash flows coming from my operation which will take care of my funding requirements. So if that is the assumption that we have made, I go back to my sheet and I figure out what should be the average debt outstanding. While taking the average debt outstanding, I will take an average of both current portion of the long-term debt, short-term bank borrowings, as well as long-term debt. So I'll take both of them and I'll do an average it out. So average of opening and closing. So FY12 is equal to average of, I go to the balance sheet, average of current portion in FY12 plus long-term portion in FY12, comma, same thing for FY11. So this plus this, and I'll say enter. So we'll end up getting a very small figure. You drag it this side, then you drag it this side. For FY10, ideally this should have been an average of FY9 and FY10 figures. Since FY9 figure is not there, so delete this and make this only the FY10 figure, only for the purpose of seeing a trend, that's all. Otherwise, if that is the case, then you drag the formula because you have already estimated the debt in the future years. So you will see everything has come up here. Now the only thing that I need to apply on this is the rate. What is the rate that I should apply on this? So now I go back to my case. I further communicated with the investors department. So you can see that they have responded to the query that I have raised. So I have written to them that why interest expense is so high when the debt balance is so low. So they have said that the interest expenses comprising of these things which I have explained. So I further communicated with them, which was over phone, so I can't produce it here. But when I communicated to them, they further told me that roughly the commitment fees turns out to be close to 0.7% of the borrowing facilities in the past. LC charges close to 2% and interest rate 2%. All of these make sense to me because the commitment fees is in India, it's also very close to 0.5% to 1% depending upon where you are borrowing. So a weighted average percentage of 0.67 is fine. LC charges, because it's a non-fund transaction, the bank has yet not spent on behalf of you, but it has given a letter of credit. It stands as a guarantor behind you. It still takes a risk. So the interest rate that is going to charge on that non-fund transaction is going to be very low. Plus, since it has issued an LC, it has done some processing work for you. LC needs to be transmitted through a very secure network. So the transmittal of the LC also happens through a very expensive route. So all those charges add up close to 1.8 to 2.5%. in the part of the world where I am. So if they have given me an estimate of 2% is fine. They have also given an interest rate of 2% historically. So they have given a data. First of all, I just ensure that it ties up historically. Then only I'll use that as a future year projection. So I go back to my model, I go back to my assumption sheet, I quickly make some assumptions. So commitment fees, this commitment fees is a percentage of syndicated facility. Then second thing is LC charges, percentage of LC outstanding, then interest charge, percentage of average loan outstanding. So I have fixed the framework. The data that they have given I'll now put in here. So commitment fees, I go back and see where it was. So they have given me an indication of 0.67%, 2%, 2%, so 0.67%, 2%, 2%, and I'll first see if my historical numbers are tying up or not, and then I'll retain that at the same level. So I drag it down further and go to my interest expense sheet. So my first calculation should be through now. So what is my commitment fees? What is my LC charges? What is my interest expenses? So total bank charges and interest. So let me see if I'm trying to work it out. So commitment fees, since average for FY10 is not available, retain it at the last year's level. You can see that the figures are very stable, so it doesn't matter much. I should have ideally picked up FY9 figure and taken an average. You know how to do that, so I'm not displaying that. So commitment fees should be, I go back to my assumption sheet. Commitment fees is this percentage of syndicated facility. So this multiplied upon syndicated facility average, enter. LC charges should be, I go back to my assumption sheet, this applied on average LC outstanding. Interest expense should be, I go to my assumption sheet, this multiplied by average debt, enter. Then I say sum. So I have done a summation, I format this, and then I drag this throughout. Now interest expense from P&L. So I have to do a cross check because I am relying on the information provided by a third party. So what is the interest expense historically? So this should be equal to, go to the P&L and figure out where the interest expense is. So interest expense they have listed out here. So I'll link this equal to, so historically this is the figure that they have given. So I increase the decimal for both of them, the calculated figure as well as the figure that they have reported. And look at the kind of match that is happening over here. So I do a check. I'm willing to live with a value which is different in the second place of decimal or beyond that. So I do an absolute check. So this minus this should be less than 0.01. If that is the case, then I'm happy. So it reflects a result of true. And I perform this operation for up to 3 places of decimal, so you can see the kind of match that is happening. So I'm happy that though there is a mismatch, the mismatch is good enough to ignore. So I think that the information that the company has provided is good enough, and if that is the case, then I will drag this, and my interest expenses, then my interest expenses through from this calculation. So I'll now link this interest expenses to my P&L. So I go to P&L, interest expense, I have now calculated. So this equal to, I go to this and I simply link it to this place and I drag it. So my interest expenses now complete. The next line item is interest income. So I go here, interest income, as I have explained last time. Interest income is coming from excess cash balances. So interest income as percentage. So it's a percentage of what? It's percentage of cash balance and short-term investments. This I have explained in the last session as well. So in the balance sheet, what will be the interest-bearing items that you will foresee? So the interest is going to come from cash and short-term investments, if at all. So now I can do an average of opening balance, average of opening and closing balance. But since I don't have closing balance for the future years, closing balance will depend upon the cash flow statement, which in turn will depend upon what interest I'm incurring, what interest income I'm having right now. So this will lead to a circularity. In order to kill the circularity at this stage, and I'll rebuild it again once I am through with the model, I'll say percentage of opening, cash balance and short term. So let's see what it was. So in FY11, I figure out what was the interest expense, interest income as a percentage of opening FY11 balance sheet. So opening figure in the balance sheet. So opening is FY10 closing. So it should be sum of cash and short term at the end of FY10. So I'm linking FY11's interest income with FY10's balance sheet, primarily because I want to avoid circularity at this stage. Once I'm through with the model, I'll rebuild the circularity. So I'm taking it as percentage of opening cash balance. You can take a percentage of average of opening and closing, but the moment I do an average of opening and closing, since I don't have a closing balance because I don't have a cash flow, and I won't be able to predict the cash flow unless I freeze my interest income as of now. So it will lead to circularity. I want to avoid that circularity. So look at the kind of stability that you have. So this should be equal to this. So I retain this in the going forward years, and I'll link this to my interest income. So this should be equal to what I have assumed for FY13, acting on this year's opening balance, which means FY12 closing balance. So this multiplied by sum of, I go to the balance sheet and pick up FY12 cash and short-term investment, a year lag. I have intentionally kept that. So you will get a figure for this year, but you won't get any figure for the subsequent years because you have not modeled the cash flows. So as of now, it's blank. The moment you model it in the balance sheet, these figures will automatically get populated. So I move down. So income before income taxes, I'm through with that figure. I need to estimate the provision for income taxes. So let's say what they have provided for, how much they have provided for in the past. So provision for income taxes. So I go back to my assumption sheet here. Now I am moving towards net income assumptions. Tax is definitely not a financing assumption, so I leave that. I'll make use of next header. So provision of taxes, I'll figure out what percentage of PBT it was historically. So this should be equal to, I go to my P&L and figure out this as a percentage of PBT's profit before tax. It can be income before income taxes as well. So this percent, I drag it. So I get an estimate of 27.6%. So this is on the basis of historical trend. Again, look at the kind of stability that's there. So it's stabilized in a close proximity of 27%. So you can either retain 27.6% figure or see how the things are shaping up in this quarter. So I open the Excel file, which is 10Q filing. All of you had got this file last time. Is the quarterly filing, and you are also familiar with the file because I have shown it to you. So I go to the income statement and I figure out what is happening in this quarter. So this is the first quarter, and figure out what is the provision for income taxes. So this equal to this divided by, so it's 26.8%. Percentage, enter. Now I go to 10Q filing and figure out if management has got any view on that. So page down. So it's a first quarter filing for this year, 10Q instead of 10K. Let's go down. If management is talking anything about this, it's very important for you to know. Otherwise, now there was something that they have talked about this. Effective tax rate for 3 months was 26.8%. We have seen that. Now let's come down if they are going to talk further about this. Segment reporting, so I continue to move down somewhere. They must be talking about taxes. So let me see if I am able to locate that. I'll just show it for one of this so that you know. Now here I have looked at provision for income taxes, the effective tax rate. They are giving an opinion. So the lower effective tax rate is this. We expect fiscal 2013 annual effective tax rate to be in the range of 26% to 27%. So management has already opined it's going to be 26% to 27% for the entire fiscal 2013. So I come back to my assumption sheet and see if I am in relation with that. So if I assume it at the last year's figures, it's going to be in contradiction to what management feels now. So management feels that we expect for the entire fiscal 2013 it will be close to 26 to 27. So I come back to my 10Q filing and figure out what it is. So it's 26.8. So I'll better retain this figure. It's a figure lying between 26 and 27. And it's also different from last year figures. So I'll say 26.8% on the basis of quarterly result. I'll keep the same figure for my future years. I'll drag it and I'll apply this percentage on my P&L. So this provision for income taxes, this has got applied on this. So this is EBIT, this is PBT, profit before tax, and whatever assumption we have made, the assumption has got applied on this. So now we have calculated net income. Now we need to calculate the net income which belongs to Accenture's shareholders, which means you have to subtract the part of the earning that belongs to non-controlling shareholders. So here I'll just like to demonstrate how the consolidation happens. So ideally, I mean, the way Accenture is behaving, it's Accenture PLC is at the top. It has got a subsidiary, Accenture SCA. This Accenture SCA has then got multiple of subsidiaries below that, each one of them being located in a country or a geography. The earnings, so all the businesses are carried out by a series of, or by a set of subsidiaries within Accenture SCA, which in turn is parented by Accenture PLC. So ideally, earnings of all the subsidiaries should be made available to me. Within each subsidiary, I know how much is owned by the parent and how much is non-controlling stake. So let's say that I have a parent company here, and then there is a subsidiary company. So if subsidiary company, there is a 90% which is owned by parent and 10% by minority shareholders. So while consolidating the earnings of subsidiary with the parent, each and every line item in the P&L will get added till net income. So net income of the consolidated level will be net income of parent plus this. Below that will be a line item for minority shareholders, and from that I will actually subtract 10% of earnings of the subsidiary from that, because this earning belongs to this minority shareholder. So ideally I should be knowing the net earning of all these subsidiaries and what is the minority shareholder in each one of them to actually figure out how much of the earning of each of the subsidiary belongs to minority shareholders. If I don't have that information, I'll just try to figure out on a gross basis what proportion this has been historically. So I'll figure out what is the proportion of this of the net income on a gross basis, and I'll extend the same percentage. So if I'm trying to do that, I'll copy these two line items. I'll go to my assumption sheet. I'll simply paste both of them, and I'll say as a percentage of PAT. Control C, come down, Control V. So what was this as a percentage of PAT? So this should be equal to, go to your this divided by this. Now remember, I'm going to drag this formula downward as well, so I'm going to freeze this so that this moves column wise. So this changes column wise, but it doesn't change row wise. So I drag this and I drag this downward, then I drag it subsequently, so it has remained at 8.4, 1.2%. Let's go to the 10Q filings. Some share exchanges would have happened this year, so figure out where it stands currently. So currently in the 10Q filing, I have located net income attributable to minority shareholders. This is this. So this minus, I figure out what percentage this is of the net income. So this is 1. The second one is this divided by this. So control C, I take the same figure for this year. This, so I retain this, so 7.696%. So it's 7.696%, and this is 1.0782%, so 1.0782%. I retain both of them at the same level in all the future years. So I'll apply the same percentage on the P&L, and you will see that my P&L is complete. So I've applied the same percentages and I have got my net income here. So with this, I'm through with P&L, so I'll take a short pause. You guys take a look at it. If you're not comfortable with anything, just let me know. In the process, I've also completed my interest expenses sheet. So my P&L is through. I'll just see some of the questions. So please look through this working and just let me know if there is anything which you have not understood conceptually. Well, so there is one question is from Bakshi. This LC, I believe the LCs will be for work being outsourced by Accenture to other vendors. That can also be true. See, LCs are issued primarily for two purposes. One is, so either you are buying some goods from a person, so in that case, if you are a buyer, you will issue a LC to a seller. Or if you are a service provider, you will submit an LC to your customer if the customer wants to activate or ensure performance from you. So if service provider, I mean, if you're paying to a service provider by means of an LC, even that is a possibility, so you can link it from that perspective. So irrespective of what it is, so if you're thinking that it's towards the service provider, then it will be linked to the cost of goods sold. So express it as a percentage of cost of goods sold, which in turn has been expressed as a percentage of sales. So again, it will get linked to a percentage of sales. So irrespective of what it is, this is just to understand. I mean, I can agree to what you are saying as well. It can be to the subcontractors you are deploying. So if that is the case, again, the linkage is still be with the sales or with the cost of goods sold, and since both of them are also linked, so mathematically your model is correct. If there is an information which tells you to believe so that it's more towards subcontracting, it's fine. Otherwise, my understanding is, on the basis of talking to the people, most of the time the government institutions will actually insist for a standby letter of credit which you will issue to them. So I've linked it to that. Otherwise, your logic is also fine. So I will accept your logic as well. But in any case, mathematically, you will express it. Can we have the recorded video of second class? This was again, the link was sent. I don't know what has happened. Considering the belief in the US to tax the higher bracket, do you not feel it more appropriate to increase the provision of taxes to about 27%? Currently, I have kept it at 26.82% on the basis of what it is in the first quarter filing, and secondly, what management feels and how they have opined in the 10Q, recent most 10Q. So they have expressed that it will be between 26 and 7, so I can take 26.5, any figure between 26 and 7. Since 10Q reported close to 26.8%, which in turn also happens to be closer to 27%, so anything, I mean, I'm okay if you take any figure from 26.5% to 27%. I have taken a figure which already appears in a 10Q so that I have a backup for that. Otherwise, 27% is also good enough. Historically, it has been in the close vicinity of 27%. So it's fine if that's what you are taking. I mean, you need not have exactly the same assumption that I am taking. As long as you understand what is the reason behind that, it's fine. So I'm okay if you are keeping it close to 27%. So 27%, so Mr. Goyal, I think 27% is also good enough. Projections for minority interests are not taking the historical trend, which has reduced from 12% to 7%. You are right, because every year some of the shareholders must be bought out by Accenture PLC. So that's the reason why it's reducing. And management is also, they are mentioning it in their 10K filing as well as here. So you can see net income attributable to non-controlling interests. So it has gone down from 9%, from 8%. So currently it's standing at 8%, 7.8%, 9% last year. If you read through the 10Q filing, you will see that there is a declining trend. So 10K filing also says somewhere that why it's going up. So if you recall, we have read that the percentage is actually falling. So percentage is actually following. They might be buying out the minority shareholders slowly and slowly. Hence, minority shareholders is, so contribution of PAT towards minority shareholder is falling. So that observation is correct, and I have retained a trend which I see in the latest filing. Now, in future also, going by the trend, it should fall. But since I don't have any information to what extent they will buy out or what will happen in this field, I am retaining it at the latest information that is available with me. Right, so your question is, I mean, going forward, I don't know what kind of decline it will happen, and this is not going to play any role because ultimately minority interest today is going to be subtracted from the valuation. So you can model it to a declining 7.5%, 7%, 6%, but then that's going to introduce one more variable to a model, and it will be very difficult to justify. A falling trend is definitely there, but to what extent it will fall by 0.5% or 1% is difficult to model. So you can model a declining trend. I'm fine with that as well, as long as you do some more research on this and figure out why the decline is happening. The decline might be happening on account of buyout, that is one. But if that is the case, then what extent of buyout will happen this year, next year is very difficult to predict. So I'm retaining it at the latest available information with me, but we can decline the trend as well. Can you provide me PDF for 10K and 10Q? Now it's too late to ask that question, Jitin. I think we are in third webinar session, and if that is the question that you are asking, it will be difficult for me to keep a track of that. You can download both of these from the Accenture website, or you can actually request our administrator. So I think my administrator must be looking at your request. He will be providing you those things, so don't worry about that. Do we need to normalize the PAT if there are exceptional items like restructuring charges, product development? Yes. If the restructuring charges and product development are significant in value, we need to normalize that. Ideally, we should do that. But how is the management guidance for just one financial year used and extrapolated to next 5 years? That's what I'm saying. I mean, I'm not just using the guidance for one particular year. What I'm doing is I have seen what is happening in the past. So in the last 2 years, it has remained in the close vicinity of 27%. In this quarter, it is 26.8%. For the entire year, they projected it to be close to 26 to 27%. There is no indication from the management that revenue from geographies, the proportion of revenues from geography is going to change drastically in the coming years. So proportionately, the revenue contributed by each geography, I'm assuming that it will remain same, because I'm not forecasting my revenue on the basis of geography. So if the proportional revenue from geographies across the geography is going to remain same, there is an indication of 26.8% for the entire year. The quarterly revenue, quarterly tax forecast is also in this range, and historically it has remained in the vicinity of 27%. Any assumption close to 26 to 27 or 27.5%, I'm fine. So if I'm making an assumption close to 26.5, 27, 27.5, I am okay with that. But if you are taking any assumption which is significantly different from 26.5 to 27.5%, I will add 27.5%. I'll ideally advise you to refrain from that. So don't alter the trend and retain it at a level which is in close vicinity of what it has happened historically and where it ties up. So you can have a different tax rate for ultimate for next 2-3 years as well, but keep it in the close proximity of 26.5 to 27.5%. So these percentages or the assumptions that I have taken over here, your assumptions can be different from the assumptions that I have taken. I mean, it need not tally with each and everything, but ensure that your assumptions are not significantly different from what it has happened in the past, because I don't have any other source of information. This revenue figures can be totally different. But since Accenture has achieved stability in terms of its revenue, in terms of the proportion of revenue coming from different geographies, it's ultimately going to be an effective tax rate. So the total taxes paid by all the subsidiaries in different geography upon total gross PBT. So net, I think since the normalization has already happened, this will be in a close proximity of 26.5 to 27.5%. Now, are these tax rate for a particular country? No, this won't be for a particular country, because if you look at the corporate structure that I have just demonstrated, Accenture PLC functions through Accenture SCA. Accenture SCA has got a number of subsidiaries. Read the corporate organization structure in the 10K filing. It will tell you how the subsidiaries are arranged. So all the businesses are carried out through subsidiaries located in different geographies. So the earnings of a particular geography or of a particular subsidiary will be taxed at the tax rate prevailing in that country. So while consolidation is happening, it's not that entire PBT has got consolidated and then a consolidated tax rate applies. Each subsidiary would have already paid a tax. So there will be a PBT and there will be tax for each subsidiaries. While consolidating, they would have simply got linearly added. So this is an effective tax rate that we are talking about, and it's the weighted average tax rate of different geographies. Fine, so I now move to the next section, which is towards the balance sheet. So I look at the balance sheet now. There are many more things that still needs to be done, so I'll just quickly move to the balance sheet. So I'm barging into the balance sheet for the first time. So look at the line items of the balance sheet and also look at some of the gut feels that we have estimated at the beginning. So look at the total size of the balance sheet first. So total size of the balance sheet is close to $16 billion, so $17 billion. Look at the estimate of cash. Cash alone is more than 1/3 of the balance sheet. So cash alone is more than 1/3 of the balance sheet. Look at receivable from the client. So cash plus receivable from the client. So cash plus receivables, they will constitute half the balance sheet. 6 plus 3, 9. 9 is more than half of the entire balance sheet. So if you have understood cash and receivables, you will see that you are already halfway through with this. Then there is a short-term investment. So if there is a surplus cash, ideally they should invest. The investment still appears to be very low in comparison to the total cash that they have. Receivable from the client, you understand. Unbilled services is one term. Then there is a deferred income tax. Then there is an unbilled services. Property and equipment is capex part, so you will see that non-current assets or the capex is very small in comparison to the total balance sheet. So it's again one of another anticipation coming true. Goodwill, so we realized that, or we at least made we had an understanding at the beginning that if the company has got a surplus cash, no capital expenditure to do and no debt to retire, ideally it should pay out dividend or it should be doing M&A. If it's doing M&A, it must be having goodwill. So you will see that goodwill is also appearing here. Then there is a deferred contract cost, then there is a deferred income taxes. So again, there is a deferred revenue, so we need to understand what are these terms. So just to keep the thing simple for you, and since there was a query in the last session as well, I have extracted few words which are appearing here for the first time, and if you are encountering it for the first time, the explanation lies here. So this is a place where the maximum complication can happen in terms of revenue and cost on a balance sheet. So there are few contracts where Accenture is getting paid in advance. There are few contracts where Accenture is incurring the cost, but the money for that or the reimbursement for that is coming later down the line. So that's the reason why there is a deferred revenue, then there is an deferred cost both. Then there is an unbilled services. So let's look into that. If you read through this, if you are encountering these terms for the first time, you will it's not very difficult to understand their meaning. So unbilled services is that part of revenue which has been accrued but which has not yet been billed. A common example of this is a power bill. Let's say that you get your power bill on 31st of every month, and the billing for that happens, let's say the cutoff time for your power bill is 31st of every month. The person comes and takes a reading, and then he goes and processes and issues a bill on 1st or 2nd or 3rd. So if you are sitting on a particular date, so if you are preparing your balance sheet on 15th of next month, you have yet not issued the bill for that, but the entire revenue corresponding to 31st of that month has been accrued to you, though there is a lag between reading and billing, so bill has not been prepared. So it's that part of the revenue which is yet to be billed. So it's unbilled services. So it will appear as a receivable kind of thing on the balance sheet. So if you go through this, unbilled services represent revenue recognized to date for which amounts are currently unbillable to the customer. So let's say on the date of balance sheet you have actually completed 15% of the task, but as per contract you can raise the first invoice only when you have achieved a milestone which is still few months away. So this entire 15% of the work, let's say that you can raise your first invoice only when 25% of the work is over. Today you are sitting at a date on which 15% of the work is over. Since you have not achieved the milestone, which is 25% work completion, you may not be able to bill it to the client. But the revenue has got accrued because you have done 15% of the work, but the contractual agreement says that you are not able to bill it. So this 15% of the contract value is get recognized as unbilled services on the balance sheet. This is also very similar to advances from the customers or a deferred. This is also this is in converse to advances from the customers. So the opposite of that is a situation where company has got paid in advance even though the service is yet to be performed. So here the company has, in the first part, the company has, in the unbilled services, company has performed the service, but they have not yet raised the invoice. In the second part, there is a situation where company has got paid in advance. So 10% mobilization advance has come towards a consulting assignment. So that is very similar to advances from the customers or deferred revenue. So that gets classified as unearned revenue in the balance sheet. It's that part of the revenue which has not yet been earned by you, but it has been paid to you. Deferred income tax asset and liability. These are the popular terms with chartered accountants. You know a deferred tax liability arises if there is any line item in the P&L which has a different rule for treatment in books, and it has a different rule for treatment for income tax purposes. So a deferred tax liability will be created if tax depreciation rate is different from the book depreciation rate or the accounting depreciation rate. Similarly, some contributions for which tax relief is provided on a paid basis, but on the accounting entries are determined in accordance with actuarial valuation. So this will give rise to a deferred tax liability. anything which has got a different treatment for the purpose of books and tax purposes will lead to a deferred tax. Now, asset or liability will depend upon what you have paid in comparison to what you should have paid. Similarly, deferred tax assets is created on the basis is created primarily if there is a carry forward losses. Now, to what extent carry forward losses are allowed, to what extent losses are allowed to be carried forward, and if there is enough evidence in place that you will make sufficient profits in the future years to absorb all the losses in the past years, if that sufficient understanding is there, management generally looks towards creation of deferred tax assets. So now the current portion of these two deferred tax asset will go to the current asset or current liability. The non-current portion will sit in the non-current assets or the non-current liability, depending upon whether it's a deferred tax asset or a liability. Similarly, in the unbilled services, there will be a current portion, there will be a non-current portion. Deferred contract cost. So this is another line item C. A deferred cost is a cost that has occurred in transaction but will not be expensed until a future accounting period. So an example which is relevant in context of Accenture is written here. While setting up an outsourced service center, cost of implementation included prior to the services going live. So you have made some expenditure towards setting up a call center. However, the call center has not yet gone live. So all the expenditure that you have done so far in getting the thing live will be recorded as a deferred cost. You will expense it in the P&L as and when you start charging the bill rate to your client. So let's say that first 3 months have been given to you to launch a call center. From the 4th month onward, your billing will start. So all the expenses that you've incurred in the first 3 months to set up the call center will be recorded as a contract cost. And once the billing starts from 4th month, it will be passed or it will be expensed in the P&L in proportion to the contract value realized in that particular, or contract value accrued in that particular period. So contract cost is like a bulk of cost which has been recorded in the balance sheet, and it's slowly and slowly depreciated or amortized through P&L as and when revenue is getting realized in the proportion of revenue accrued. Similarly, there is an income tax payable. Income tax payable is the portion of the income tax which you are supposed to pay, which you have yet not paid, primarily because the deadline for the same has not rolled out. So that's the reason why there is an income tax payable. Then there is a deferred, it's different from a deferred tax liability. Deferred tax liability arises if there is a temporary difference between accounting, if there is a temporary difference which arises because there is a different treatment of a cost item as per accounting rules and as per tax law. So that gives rise to a deferred tax liability. Income tax payable is different from deferred tax liability. Income tax payable is that portion of the tax which you are supposed to pay and which you will ultimately pay, but you have not yet paid because the timeline for the same has not yet come. So that's the reason why you will see a current portion of income tax payable. Mostly it should be current portion of income tax payable. There is a non-current portion of income tax payable also in the balance sheet, which I have not been able to figure out a reason for. Despite efforts, I couldn't figure out why there is a non-current portion of income tax payable in the balance sheet. So if you guys have got any suggestion, you can educate me on that. But even after reading the entire 10K, I couldn't realize why a portion of income tax payable sits in the non-current portion. It should ideally be a current liability. Deferred tax liability will sit in the current as well as non-current portion, both, depending upon how much of the deferred tax liability is going to be utilized in this year. Then there is an accrued payroll and related benefits. Accrued payroll and related benefits, why it appears on the balance sheet, because a part of the wages, salaries and commission and bonuses are yet to be paid on the day on which your report was formulated. So as an example, I have told you why it should appear. So let's say that every month the salary is processed on 5th of next month. So for December month, the salary gets processed on, let's say, 5th of January. So if you're preparing the balance sheet on 31st December, this entire salary, wages, commission, bonuses, or whatever you would have promised to your employees will remain payable. So that will be accrued. That's accrued because your P&L is prepared on accrual basis, but since you have not yet paid out, that will stand as a payable portion on the balance sheet. Retirement obligations. Now retirement obligations, there are two types of retirement obligations you will see on a balance sheet. one of them corresponds to asset retirement, another one corresponds to employee retirement. In case of Accenture, it corresponds to employee retirement because in 10K they are also talking about retiring some of these facilities going down. So here they have shown an obligation, retirement obligation, and they have made a note number 3. In note number 3, let's say what they are talking. So in note number 3, they are saying that this is an obligation towards pre-incorporation partners. So it's again a part of the compensation which you would have promised to the partners post their retirement. Slowly and slowly they have discontinued this practice. So I know that this retirement benefit is also towards, it's not towards, these retirement obligations are not toward asset retirement, but it's towards employee retirement. So I come back to my slides and have a look at it once more. So employees retirement obligation, what will that comprise of? There are retirement obligations that will be planning per employee. So there are some post-retirement benefits like pension, which you would have committed. Then there are some paid leaves, membership to a club, membership to a gym, or membership to a medical facility, funded retirement plans. So all of these will actually accrue as a retirement obligation on the balance sheet. So these are the 5 or 6 line items which I felt some of you have asked in the previous session, and some of you might find it difficult to explain. So that's the reason why I have documented it. Wherever possible, I have also listed an example for you so that you can actually understand it. So wherever possible, I have provided an example so that those who are listening or those who are encountering these terms for the first time, they still understand and at least retain why these things should be coming. So here also I have given you an example of, so I have given an example why deferred contracts cost should arise on the balance sheet. So if you go through this peacefully offline, you will see that all the terms have been comfortably explained over here. So I will now move to my balance sheet. Now understand, the more complicated the modeling is, I leave all the complicated parameters which is starting with deferred, because in order to build or in order to model a deferred tax asset or a liability, now look at the kind of variables that you need. The deferred tax liability will again arise because of timing difference, because of timing difference of depreciation. So in the book you are registering depreciation at one rate, for the tax purpose there is a different rate. So in order to correctly estimate this, I need to know what has been my capital expenditure through different asset class, what is the book depreciation rate, what is the income tax depreciation rate, how much each one of them has got depreciated so far, and then going forward, what will be the difference between their depreciation. If I know this much information historically, then I need to further project how my capex will be split across different asset class, what are their depreciation rate for books and IT, and hence I will project it. So either you have that quality of information available with you, or you decide to retain them at the same level. When I am deciding to retain them at the same level, it doesn't mean that practically it's remaining at the same level. Practically what's happening is a part of that is getting utilized, new assets have been purchased, that gives rise to additional deferred tax liability or asset. So there is an addition and deletion happening every year, but I am retaining or I am assuming both of them to be at the same level so that net you end up getting the same value. So that's the assumption I am taking for all the items which is very difficult to model. Similarly, if you are trying to model a deferred revenue or a revenue which has got or advances from the customers, so I need to know within the entire order book how many orders will have a clause for advance payment. Now if there are clauses for advance payment, what is that advance as a percentage of total contract value? Once we have that information historically as well as for the new projects, I will be actually able to model them correctly. Since in the absence of those informations, I'll again retain all these deferred all these line items which start with deferred at the same level as it was historically. when I am maintaining them at the historical level, that doesn't mean that they are not changing. They are changing. There is a deletion every year. There is an addition also every year. But both of them are nearly close by. That's the reason why it comes back again to the same value. So with that logic, short-term investments, historically it has remained very low. So I will retain it at the same level as it was last year. So what I am doing, I have given a clue of that in the column adjacent to your model. So I'm retaining it at the same level. Receivables from the client, I will model it. So I'll go back to my assumption sheet. I'll say working capital assumptions. I am in a position to model this receivables from the clients. So I copy this and I paste it here, receivables from the client. I'll express this as a days of revenue. So I'll figure out how many days of revenue is still receivable from the client. So the standard formula, I'll do it one for one of them, and I am sure you all will be in a position to do it yourself. So equal to average of receivable figure from the balance sheet. So receivable from the, so average of escape. So I'm doing it for FY11. So this is average of opening and closing. So average of receivable in FY10, comma receivable in FY11 divided by per day sales of FY11. So this I have explained umpteen number of times in the classroom. Since all of you are our previous student, I am sure all the instructor would have explained this in the respective sessions. So I don't see any difficulty modeling this at your end. So I'll not delve here much. So FY11, this was the position. FY12 is again very close by. It's again because the company has achieved so much of a stability. So going forward, I'll either bring it down since there is an increasing trend. So at best, I can retain it at the same level, 39, 38.75, 38.5, because the business has become so stable that bringing it down even by quarter of a day is appearing to be difficult. So with this assumption, I'll model one of these for you so that, so receivable for the client in FY13 should be, so I say equal to, I go back to my assumption, I say that 39 days of sales will be outstanding. So 39 multiplied by my annual sales in FY13. So this is my annual sales. I'm saying 39 days of sales. So 39 days multiplied by annual sales divided by 365. Now this should be the average of last year balance and this year's balance. So I'll nullify the impact of average. So I'll multiply it by 2. So this has nullified the impact of average. So this is now, this figure is equal to sum of last year balance and this year's balance. So minus, I go back to my balance sheet and do last year's balance. I end up getting a figure here. So I'll drag this. Unbilled services. Unbilled services, it's again a part of that part of the revenue which has got accrued but you have not yet billed to the client. So it's a portion of the revenue. So let's say that you raise a bill on 15th of every month. Today you are sitting on 30th. So for 16th to 30th, so the work corresponding to 15 days of the second half of the month, you have actually worked and that has got accrued. But you have not yet billed because you bill it once every month and the billing date is 15th of every month. So that 15 days of revenue, which is the second half of the particular month, will be recorded as an unbilled services. So it's again a part of the revenue. It's again a part of the revenue which has got accrued. So I'll again express unbilled services as a portion of, so unbilled services, you can express this again as a percentage of revenue or as a days of revenue, and do the same operation that I have done for receivables from the client. So this I'm not going to explain. I'm sure you are going to do it yourself. Deferred income taxes. I have said that I have decided to retain all the terms which start with deferred at the same level as it was last year, because it's very difficult to model it accurately in the absence of any information. Ultimately, your aim is to figure out a cash flow, and the cash flow is not going to be impacted by items like deferred income tax and liabilities, because ultimately they are accounting entries at the end of the day. So I'll retain it at the same level. Other current assets, now there is a depreciation amortization item in the cash flow. So since it's getting amortized, I need to figure out where the intangibles are hidden, but as of now I don't have any information, so I will retain it at the same level as it was in the past, and I'll drag, but once I figure out how to treat this, I will come back to this. So I have done it at the same level, but I'll highlight it because I know a rule to take care of this. So on the current asset side, cash, I will do it towards the end. Other two line items I have projected. Unbilled services can be linked to the revenue, and you know how to express that as a percentage of revenue. Right, so deferred I have done. So now I move towards similarly unbilled services net. So non-current assets. So this is the non-current portion of the unbilled services. So again, express it as a days of sales and do it yourself. So in the assumption sheet, working capital, below working capital, you say non-current assets and liabilities assumptions, express unbilled services non-current as a days of revenue, exactly the way you would have done above. Control V, and then back calculate it. So express it how the level is historically, which I'm sure all of you can do now. So this one you can do. Investments, retain it at the same level as it was last year. It's anyways a very small value. So the value is very small in comparison to the total balance sheet size, plus it has remained at the same level or in a very close proximity of each other, so retain them at the same level. Property and equipment net is something which I have to model. Goodwill, in the absence of any information, keep it at the same level. Goodwill will be subjected to impairment. So once I model the depreciation and all, I'll figure out how to take care of that. Deferred contract cost, retain it at the same level. Deferred income tax, same level. Drag it, finish it off. Move towards other line item. So current liabilities, accounts payable. Accounts payable is nothing but the payment which is due to your service providers, subcontractors. So assumptions, standard way to do accounts payable is to link it with the days of cost of services, exactly the way I have linked receivables with days of revenue. So this also I'm sure you can do. Deferred revenue, retain it at the same level as last year. I'll tell you how to model the accrued payroll and related benefits. So this is something which will require some modeling. So I come back to my assumption sheet. I'll model accrued payroll and related benefits. So first figure out total number of employees, right? So total number of employees in FY12 was 2,57,000, which you have seen in the 10K filing. Total number of client facing workforce. So this is again numbers. So where am I going to get this data? I'm going to get this data from my revenue buildup, because in the revenue buildup they have listed the total number of client facing workforce split across different sources of revenue. So this is equal to sum of consultant headcount here, comma, this, comma. So you add all of these to actually obtain the customer facing headcount, comma, So I'll add all the all the client facing head counts or all the revenue generating head counts. I'll say enter. So it will tell you out of the total employees what portion is client facing. So remember there the employees numbers were listed in thousands of employees. So I multiply this entire thing by 1000. So this is the client facing workforce. So total workforce is this much. So non-client facing oblique. So either the non-client facing workforce or back-end workforce. So I can calculate. So this should be this minus this. So Control C, Control V. I figure this out as a percentage of client facing workforce. So I figure out what is the non-client facing workforce as a percentage of client facing workforce. So I end up getting 19.6%. So retain the percentage. So approximately 20% of the workforce of the 20% of the workforce is towards non-client facing role. So the non-client facing workforce means what? They will mostly be comprising of team members in finance team, accounts team, strategy team, HR team, business development team, sales and marketing team, the secretaries of all the partners, travel desk, reception, facilities management if these facilities are not outsourced. Otherwise, these are the people which will generally comprise of back-end workforce. So 20% of client-facing workforce is non-client facing workforce. So now I know what is my client-facing workforce in the historical year. So I'll drag this. So I'll apply this percentage. So remember that I've expressed 42,000 not as a percentage of total employees. I've expressed this as a percentage of client-facing workforce. So this percentage come out to be 20%. So for every 5 client-facing workforce, there is 1 non-client facing workforce or a support staff. So this is nothing but this percentage applied on this. So you end up getting the non-client facing workforce. So you add them. So you will end up getting total workforce in a particular year going forward. So this becomes the total workforce. So now figure out what is accrued payroll and related benefits per employee. So FY12 balance sheet, the figure is this in billions of dollars. So multiply it by 10 raised to the power 9 divided by, you come back to your assumption sheet and divided by total number of employees. You will see that roughly $13,350 equivalent to 2 months of average salary has been set aside as an accrued payroll and related benefits. So roughly a month of salary or a month of salary plus some bonuses is coming here. So you retain the same figure going forward. So this is what you are going to model, or model some hike of 5% or 10% the average increase in salary. So you can model it for the historical years and see if it has gone up or gone down. More or less it should remain in the close proximity because the salary or the compensation hike has not been really great in last 1 or 2 years. So either you see what the growth rate has been or you see by what percentage salaries have been going up in a particular geography in the last 1 year, last 2 years. You model the same growth rate here, and this multiplied on total number of employees should give you the figure in the balance sheet. So my accrued, this should be per employee. I am modeling this much. I'll multiply this with total number of employees and I'll divide this by 10 raised to power 9 to bring it back to billions of dollars. So I drag it here, you end up getting this. Accrued consumption, I'll keep it at the same level as last. Income tax payable. So I go to my assumption sheet. I say income tax payable. Express it as a percent of provisions for taxes. So out of total provision, what is it that is yet to be paid? So this is equal to, I pick up the figure from balance sheet. This portion is payable from the total provision that I have made, which is in the P&L. So I search for it in the P&L. Say enter, I realize that roughly 29%, 24%, and then I drag it further, 23%. So retain the same figure going forward. All right. Or there is a declining trend, you can decline it. So roughly 1/4 of the tax is yet to be paid, which means 1/4 of a yearly tax, which means 1/4 means 1/4 tax is yet to be paid, primarily because your deadline is still far away. So which is good enough, so you can keep it close to 25%. So go back to your balance sheet. This should be equal to the assumption that you have made multiplied upon provision of taxes. I have mentioned the unit here, so I go back to my P&L. Provision for taxes here. I say enter. You will end up getting this value. Deferred income tax. Forget it. Other accrued liabilities. Not able to figure out what it is. So you have got everything expressed here. Long-term debt we have already modeled. Deferred revenue relating to contract cost. See, it has remained at by and large at the same level, so I'll keep it at this. Now even if you take all the pain to model it, just go to the, so there is a deferred revenue here on the non-current liabilities. Similarly, there will be a deferred cost on the non-current asset side. So see, there is a deferred contract cost on the non-current asset side, and both the values will be close by. So the contracts have been structured in such a way that the deferred contract cost gets funded by deferred revenue. So there is a cash flow pending on one type of contract. There is a cash flow coming in advance from another kind of contract. And both the cash flows, a good CFO will try to match, and that's exactly what Accenture has done. So even if you try to do all the pains to model them correctly, they will ultimately net themselves off. So even if you are retaining them at the same level, by and large, you are not making any mistake here. Otherwise, if the information is available, there is absolutely no reason there is absolutely no reason why I will not model it. Or in the worst case, you may also link it to the revenue. So I'm fine with that also. So deferred revenue can be linked as a percentage of revenue. Deferred cost can be linked as a percentage of cost of goods sold. Retirement obligation, it's again something which is linked to the parameter. So I'll go back to my assumption sheet. I'll again insert a row item between accrued payroll and taxes, and I'll say retirement obligation per employee. So I'll track this matrix exactly the same way. So I have the total number of employees here. I know what is the retirement obligation is there in the balance sheet. So in the balance sheet FY12 figure, this is the retirement obligation that divided by total number of employees that we have arrived here. So multiply it by 10 raised to the power 9 because the balance sheet figure is in billions of dollars. So 5262, roughly a month's salary. So retain this parameter at the same level going forward. Multiply this with the number of employees here and divide it by 10 raised to the power 9 to end up getting the figure for FY13. Deferred income taxes, same level. Income tax payable in the non-current liability section. So far I have not been able to decode what exactly this is. It seems to me that probably, I don't know, I mean one of the subsidiaries might have paid some, I don't know. The logic that I'm thinking might not be making sense here. There is some kind of case or a litigation going on between the local tax authority in the geography in which subsidiary might be operating, and because of that, this appears to be some sort of additional tax which the company is expecting to pay over and above what they have paid in the past. Now when the decision will come, when the litigation will get finalized, then this tax will be due. So they don't know exactly when it's going to happen. Probably it's not going to happen in the next 1 year, so hence they are not keeping it in the current portion and they are taking it in the non-current portion, because the values by and large remain same in last 2 years. So I don't know what exactly is this. I don't have any explanation. So I retain it at the same level. Other non-current liabilities I don't understand, plus it's a minuscule item in the entire thing. So I keep them at the same level. Paid up capital, I'm not going to issue any fresh share, so link it with the same level. Now comes the question of treasury shares, and which probably one of you were also waiting for. So everything that I have done in modeling the balance sheet, I have put it in this slide, so that you know exactly what I have done, what I have retained at the last year levels, and why I think they should be retained, or what is the justification that I have in my mind to retain it at the last year. The items which I have linked to some parameter in the P&L, I have shown here what I have linked it to, so that it's easy for you to recall. So wherever I am retaining in the last year figure, or I am establishing the linkage, I have done this. So days of sales, no linkage. Asset modeling is something which I'll do right now. Retain. So exactly all the line items in the liability side and on the asset side, how I have built, what logic I have done it in front of you. I have spelled out the logic, I have documented it in this slide so that it's easy for you to figure it out going forward. So I put in here the equity portion is left, which I'll now explain. So paid up capital, I am assuming there's no equity infusion, so they will be at the same level. Now comes this I have done for you, accrued payroll and related benefits. I have done the entire thing in front of you. Now we come to the question of treasury shares. So why treasury shares are issued in the first place? The treasury shares are the shares which are lying idle with the company. Now treasury shares would have come from a repurchase. A company decides to buy back its own shares. So there is a paid up capital, let's say, which is currently standing at a level of $100 million, let's say. Company decides to buy back shares worth 20 billion out of that. So once you repurchase the share from the shareholders who are holding those shares, the shares come back in the hands of the company. Now company should ideally extinguish those shares. If those shares are extinguished, so the shares are no longer existing. So the paid up capital, which was initially 100, will get reduced by the amount of the shares repurchased and extinguished. So the paid up capital itself will be restated at 80, 100 minus 20. If the company has decided not to extinguish the shares but keep the shares idle with itself, so that they can reissue it again when there is a need to reissue. Now why company might be willing to retain the shares? Because there are certain places where regulatory bodies make it very difficult, or the process to issue a share is very cumbersome, especially in India. I mean, you have to take approval from ROCs, registrar of companies, and then ultimately issue a share. So there's a lot of procedural work that is left. So that's the reason why companies, instead of extinguishing it and reissuing the shares, they keep the shares within their position and they reissue it when required, so that they are not passing through the rigor of the same procedural issues involved towards issuing of a share. So treasury shares are the shares which are lying idle with the company. The company might have issued the share, to the market and bought it back from the market, or the company would not have issued it to the public in the first place. So that's how treasury stocks are created. Treasury stocks, the moment you repurchase the share, the money has gone out of the company, the share has come into the company. So out of $100 billion of paid up capital, if you bought $20 billion, you have bought shares worth $20 billion, but you have not extinguished it. So the 20 billion will be recorded as minus $20 billion against treasury shares. So where the company itself is holding its shares worth minus 20 billion. The paid up capital will still stand at 100. Against that will be a line item of treasury shares minus 20 billion. So total shareholders equity will still be 100 minus 20, 80. The paid up capital will not be decreased because you have not yet extinguished the shares. The moment you extinguish the shares cease to exist. So that's the reason why the impact will then ultimately be in the paid up capital. So net, whether the company's shares are lying idle with the company or with the company, it's by and large remains the same. So total shareholders equity will get subtracted by that amount, but otherwise it's still recorded in this. So what are the reasons for share buyback, repurchase? I have listed it on the slide so that this gives you some indication about how to model that. So in the Excel file, treasury shares, I'll retain it at the same level. Retained earnings is nothing but last year's earning plus this year's earning attributable to Accenture PLC minus a dividend. So dividend as of now I'll keep at 0. I'll go to my assumption sheet and I will make way for dividend in the financing assumption. So I'll say dividend payout US dollar billion. Historical figures will be recorded here, and future figures as of now I'm keeping it at 0 level. I'll link it to that place. So instead of this 0, this linkage now comes to the assumption sheet, dividend payout. Tomorrow if I model the dividend for dividend discount model, this will automatically get reflected. So you can drag this entire line is complete. Other accumulated losses, same as last year's level. Non-controlling stake is last year's non-controlling stake plus this year's non-controlling stake coming from here plus here. So I'll end up getting this value. Then there is a total shareholders value. So each and everything that I have done over here, I have given you an explanation except for the asset modeling and cash flow. So asset modeling is left and the cash flow is left. I would have ideally liked to complete the asset modeling, but I am getting a flash from my administrator that we have actually exceeded the time as usual. So I'll close the session and I'll look at the questions. Meanwhile, go through whatever I have taught you. The Excel file will come to you, the presentation will come to you, the video recording will come to you, so don't have to worry about that. I think my administrator will now be launching a poll. If there is anything that you want to know more, so kindly put that in the feedback so that I'll cover it or at least have a couple of slides dedicated to that in the next session. I'll look at the questions now. So if you've written a question, just be in the window. I will slowly and slowly. Fine, so thanks on the extrapolation. Maybe it is a question of how much historical perspective is considered and how much qualitative analysis. Yes, I'll agree. Right, I mean, well, there is a question. I don't know the name of the person who has asked this question, but his comment is, I mean, thanks on extrapolation. Maybe it's a question of how much historical perspective is considered and how much qualitative. Can I know the name of the asker, please? I mean, I don't see the name of the asker, but irrespective of who the person who has asked this, let me tell you that as high as 2/3 of mergers and acquisition deals, they fail to achieve the projections that are shown in the boardroom in the very first year of projection itself. The balance 30-35% of the M&A deals which manage to get the projections, manage to achieve the projection in the first year, they fail to achieve the projections in the third year. So net almost every M&A projection fails to achieve the number in third year, by and large 100%. When I say that it has failed to achieve the projection, the actual is in deviation of more than plus minus 10% of the projected numbers. So if you are trying to figure out how close your projections will be to the actual numbers, and that also on a balance sheet, it's going to be very difficult. I mean, don't even think about that. You may still try to match the line items in the P&L, but matching a balance sheet is almost impossible. So don't even worry about that. You always develop a model with the assumptions which you are able to justify. So I always build in more as a historical perspective rather than future projections, because the market conditions currently are not at all conducive or showing any kind of improvement for the future. So I'll rather prefer to retain the historical conditions rather than build in anything. Thanks for clarifying the deferred revenue cost. DTL, DTA. It might be helpful to share with the group that all these are dependent on accounting policies of the company, and any changes in those policies should be looked out for while analyzing projecting the numbers. It's fine. So I have listed what all parameters. I completely agree that need deferred tax liability asset cannot be correctly projected, but it's agreed. I mean, for heavy industries like power and all, probably you still need some kind of pointers to estimate them. And ideally, if my assignment is a paid assignment, ideally if I'm doing it for a client where I have complete access to all the private information that is required to model deferred tax asset and liability, I'll be glad to do that. I mean, modeling DTA or DTL is not difficult. It's simply the difference of the depreciation by book method and the income tax method multiplied by the tax rate. So building it mathematically is very simple, but the only thing is the variables which is required to model them, it's almost impossible to figure them out on the basis of limited information like 10K. So again, since I couldn't see the name of the asker, so it's becoming very. There is a huge jump in non-controlling interest from FY12 to FY13. Is that so? FY12 to FY13. Let me see. There is a huge jump in non-controlling interest from FY12 to FY13. I don't see any jump in FY12 and 13. In FY12 it was 0.24, in FY13 also is 0.24. So figures are in close proximity. Am I reading you correct? I don't think, and since I don't know the name of the asker, so I can't ask exactly who is the person who has asked this question. So, right. Request to share the videos. I mean, don't even worry about that. That will come to you. Thanks once again for wonderfully fine files at the earliest so that we have full week to work on them. Ideally, I'll not want you to work over the weekend, nor I will want any of my staff to work over the weekend cleaning the video or the Excel file. So earliest it can come to you is on Monday, late evening, or definitely on Tuesday. So I can promise Tuesday as a date, so they will come to you in Tuesday. Sujit, I am not clear with your question. 48% to 75%. Where is this coming from? 48% to 75%. It's 48% of what? Then there's a question, when we calculate EV of the company using balance sheet, can you please explain why? Explain what? I think this question, Moksh. I don't read your question. If you can send the webinar to recording, that will be helpful. That will come to you. Off track question, I'll try addressing that question in the next session. Can you go to the last item that we have modeled today? In P&L or balance sheet? In the balance sheet. Okay, so here this 0.48 has become 0.75. Is that your question? That is happening primarily because we have yet not subtracted the dividend that has paid, that will be paid out from the non-controlling interest portion as well. So since I have currently kept the dividend level at 0, but the company is also paying out dividend, that's the reason you will see that there is a sharp jump in the retained earnings also. So Sujit, okay, now I understand your question. So this sharp jump is primarily because I have yet not paid out any dividend from the retained earnings, either from the Accenture shareholders equity or from the non-controlling interest. So the moment I build in dividend payout, a part of that dividend will be paid out from the retained earnings of Accenture shareholders, and a part of that will be paid out from the retained earnings of non-controlling shareholders. So the moment dividend is built in, both the values will come down, and it will come down to a level which is in line with this. And Accenture has been paying a very huge amount of retained earnings as a paid dividend. It's a huge percentage, almost as high as 30 to 40% of the earnings has been paid out as the dividend in the past. So the moment I put in this, so I hope it addresses your question now. Yes, I am going to send everything to you. Don't even worry. Okay, fine. So Sujit, I think you got the point. The moment I build in the dividend, you will come across this. All pointers will be sent. Don't worry. So with this, I think I have exhausted all the questions. Are you going to send us a pointer? The question from Tanya, slide steps from today's presentation. Yes, all the presentation will come to you. Don't worry. Yep. There is one asker of off the track question. I don't know who is the person who has asked this question, hence I will not be able to address that as of now. Moksh. I will try to address if there is a one-time line item such as buy, sell of businesses or termination of JV, how to go about that. So ideally, you should have the projected values of projected business plan of the JV. Now that JV, if the JV comes into the picture, the business plan of the JV will get added to the business plan or the projected P&L of your company. It's the JV, now depending upon what shareholding, if you are a minority shareholder, only your portion of, okay, so I'll take up this question in the next session. I think this is a good question. I'll do it for the benefit of all of you. So don't worry, I'll take up this question, Moksh. I'll take up in the upcoming session. Fine, with this I have exhausted all the questions for today. Moksh, thanks, all right. Fine, so with this, I wish all of you to have a very good weekend, or a balanced part of the weekend to be very good. So let's reconnect again a week later, and probably we will be seeing through the entire exercise in the forthcoming session. As of now, we are definitely behind our timetable by 45 minutes. So let me see if I can catch it up next time. Otherwise, we'll see how to handle that. So wish you all a very happy weekend, or a balanced part of the weekend. See you again next week, same time. Thanks a lot, ladies and gentlemen, for sparing your time out of weekend to attend this session. Thank you. Thanks a lot. I sign off.
The organizer has ended the session.